2022 is really a year to forget for investors, and it does not seem that 2023 will be any better. In fact, we might be heading hard into a recession, and you have seen that the Federal Reserve has been rising interest rate again and again. Now, the Fed funds rate has increased from a near zero at the beginning of the year to a current 4.5%. And we're not just seeing only a sharp correction in the stock market, the crypto industry is also experiencing one of its largest crash ever. Even the health of some of the biggest crypto companies like Binance is brought into questions. And this is just not the opinion of myself alone. Companies around the world are preparing for the worst, laying off thousands of workers. Even tech companies, which are supposed to be cash rich and have a long-term growth trend, are cutting back a big portion of their workforce. And what is more alarming is that Michael Burry, the famous investor, has tweeted that he is still very pessimistic about the market and the bottom is far from over. Michael Burry, of course, is a famous investor now, having predicted the 2008 financial crisis, and he has also been featured in Hollywood films like The Big Short. But he has also proven himself again and again in predicting other crises such as the meme stock crisis, the cryptocurrency crash as well. So when he speaks, everyone listen. So if a recession is really coming to us in 2023, how best should we be preparing for it? Right, but before we talk about that in detail, I'd just like to thank our sponsor for this video, FSM1.com. FSM1.com got me to talk more about how we should be preparing for the year 2023, because this is one of the key topics that they will be covering at their flagship event coming up, the FSM Invest Expo. Held in 7 January at the Suntec Convention Centre Hall 403, you can of course register and join them live to hear from their lineup of speakers and industrial experts so that they can share with you on how the industrial landscape is really changing for the year 2023. On top of that, you get to participate in several fun activities that will help you learn more about investing and also help you win some over 15,000 worth of prizes up for grab that day. So if you're interested, remember to sign up for their expo coming up soon. Now, let's get back to the video. When we're talking about a recession, well, technically the definition for it is for the economy to experience 2 consecutive quarters of declining GDP. Over the past 7 decades, the US economy has actually experienced 18 recessions. And the longest one of them is the most recent one in 2008, which lasted 18 months. Well, a recession is never good news for anyone, but most likely we're going to expect huge drop in demand and goods and services, and this could lead to companies seeing their earnings drop. And because of that, companies might start to lay off their workforce to ensure their survival. Sometimes this period can be accompanied by high inflation, like currently, and this means that things will become more unaffordable over time, and people will start spending less again. So investors would also, because of the situation, take less risk and maybe invest less and become more conservative. What is interesting is that we tend to assume that the economy going into recession will always lead to a declining stock market. However, that's not always the case. In fact, more than half the time, the stock market actually went up during a recession. As investors, we might be more concerned of a market decline rather than an economic recession. And after what happened this year, surely it's not hard to imagine that this downward trend will continue in the year 2023. But in terms of the market, it's actually quite common to see huge volatility in the market every single year. Market tends to fluctuate around 10 to 20% at any given year. Moreover, to experience a market decline of around 20% is also quite common. A bear market where the stock market dropped around 20 to 30% in a given year has actually happened on average every 8 years in the past few decades. So a market downturn is something that is rather inevitable. But the good news is that overall, the market still tends to go up rather than down. And the average bull market runs around 3 times longer than bear market. Therefore, the best thing for us to do might not be trying to predict the bear market, which is a very hard thing to do, but instead we should try to get ready for the upcoming recovery that will surely come. And to do that, we need to make sure that we are in the best financial position to take advantage of the recovery when the time comes. And in my opinion, to do that, there's a few things we need to do. Firstly, we have to ensure that our finances are very strong during this period of downturn. This means that we should try to pay down any unnecessary debt that will cripple our monthly expenses on debt repayment. And so we must have the capital to invest, and we have to ensure that our personal cash flow is strong. This means we really need to focus on staying employed during this period and making sure our expenses are well covered by our monthly income. In this period of uncertainty and mass layoff, we have to cut down on our unnecessary expenses and be determined to build up our cash buffer. So having a cash buffer of around 6 to 12 months of our monthly expenses would really give us a peace of mind and make sure that we will not be pressured to sell off our stock at the worst possible time to pay off any expenses, such as our debt or maybe finance our lifestyle. I know what I described here is not an easy task to do, but if you're one of the lucky few with excess cash to invest during this time, then you can truly be in a position to be greedy when others are fearful. Of course, it is almost impossible to time the market and know when is the best time to invest. After all, we cannot all be Michael Burry. Even so, we can still utilize the strategy like dollar cost averaging to give us the best chance to enjoy the market recovery. For example, if we are able to average out our investment through dollar cost averaging, then we can reduce our risk of buying at the wrong time, such as right before a market crash. And yet, we'll still be able to stay invested and take part in the market recovery when the time comes. But of course, most of us might feel that we are an above average investor and we could easily time the market. But for that, I'd like to share one story with you. About a decade ago, Fidelity Investment did a study to find out which group of investor really does best over a long period of time. And it turns out the best stock investors are people who are either dead or forgotten that they have an account. This finding is really funny but not really surprising because in investing, we are often our worst enemy. Many investors are not able to stick to simple strategy like dollar cost averaging and just buy the market regardless of market condition. What we do instead is that we might buy aggressively when market is rallying, and then when market is crashing, we sit and wait until it's so painfully low that we might just sell and give up investing at all. So timing the market will often lead to worse performance, not better. So while keeping our own ego in check might be the most difficult thing, but it is the most important thing to do when investing. But this is of course not an issue for investors who have either forgotten their account or who are either dead. They can just keep their investment and ride through this market cycle. And as market tends to go up over the long term, it is not surprising that these people are the ones that are able to keep their fingers off the buy and sell button and do best over the long term. I think this year has really been a big wake-up call for all of us. The dream of just sitting at home and earning more than our salary during the pandemic is not a realistic one or a healthy one for the world to have. At the end of the day, the basic principle of money, like spending below our means, investing regularly, and don't time the market, can really help us overcome what the market throws at us. And based on the history of the market, every recession and market downturn have recovered. And very often, the best market return occur just the first 2 weeks of the market recovery, when nobody is even aware that the market is recovering. So instead of trying to guess where the market bottom is, staying invested will ensure that we will take part in this first 2 weeks of critical recovery, and we can truly profit from the stock market. So I thank you for your time, and if you've gotten value from this video, please give us a like and share it with a friend who you might think will benefit from it as well. And of course, do check out our sponsor fsn1.com. Remember to sign up and register for their FSN Invest Expo held in 7 January. It will be going to be held in Suntec Convention Center Hall 403. And you can always hear more from their lineup of speakers and industrial experts on how the investment landscape will change in 2023. And of course, remember that you can also participate in many fun activities that will help you learn more about investing and also, more importantly, win prizes worth up to $15,000 that day. So anyway, remember to sign up for the event, and as always, till we meet again, my name is Stanley. Invest safely.